Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, January 30. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. To quote the title of a classic children's book, the stock market in 2022 had a terrible, horrible, no good, very bad year. The S&P 500 last year declined 19.4%, its worst performance since the crisis year of 2008. But so far in January 2023, the stock market has sharply rebounded. We witnessed bear market rallies in 2022 that fueled our hopes, but then fizzled. Are we witnessing yet another head fake? History suggests we aren't. The stock market rarely posts years of back-to-back declines. On average, the S&P 500 gained 15% in years following a negative year. Of course, past performance is no guarantee of future performance, as the saying goes. But the indicators are auspicious. Last week, the main U.S. stock market indices posted another winning week and are firmly in the green year to date. Leading the way has been the tech-heavy NASDAQ, as inflation wanes and investors grow hopeful that the Federal Reserve's interest rate tightening will eventually ease. Stocks sharply rose last Friday in the wake of encouraging news about the Fed's preferred inflation gauge, the Personal Consumption Expenditures PCE Index. The Bureau of Economic Analysis reported last Friday that the core PCE, which excludes food and energy, rose 4.4% from a year ago, down from the 4.7% reading in November, and meeting consensus estimates. That was the slowest annual rate of increase since October 2021. On a monthly basis, core PCE increased 0.3%, also in line with estimates. International stocks have been rebounding as well, especially in Europe. Major economies in the European Union, notably the regional growth engine of Germany, are weathering the war-induced energy crunch better than expected. Crude oil prices have been volatile, but they're starting to edge higher again as analysts increasingly predict we'll avoid a painful recession this year. The S&P 500 last week breached its 200-day moving average, a technical trend that's bullish. The 200-day moving average represents the average closing price over the past 200 days. The S&P 500's move above that average signals a full long-term trend reversal. But you need to brace yourself for continued volatility. Past market rebounds typically have been characterized by dramatic ups and downs as stocks struggle to gain their footing. The January rally hasn't been restricted to just equities. Bonds also have bounced back this month, following a dismal year. In the years following 15% plus drops in equity prices, bonds averaged a 5.9% return. After a down year for stocks, bonds averaged a 9% return. It has been a long, frustrating wait, but 2023 appears to be the year that bonds will be back in vogue with investors. Now let's take a look at the week ahead. We face a crowded economic docket in the coming days. The major reports to watch include the S&P Case-Shiller Home Price Index and the Consumer Confidence Index Tuesday, ADP Employment Report, S&P Manufacturing PMI, Construction Spending Federal Funds Rate, Fed Chair Jerome Powell's press conference, and motor vehicle sales Wednesday. Initial jobless claims Thursday, non-farm payrolls, unemployment rate, average hourly earnings, labor force participation rate, S&P U.S. Services PMI, and ISM Services Index on Friday. The big news this week, of course, will be the Fed's decision on interest rates, which will be announced Wednesday at the conclusion of the two-day meeting of the Fed Policy Making Federal Open Market Committee, the FOMC. According to the CME's FedWatch tool, the Fed will likely boost rates 0.25 percentage points at both its February 1 and March 22 meetings and probably hold rates steady after that. Let's just hope Jerome Powell's remarks after the meeting aren't surprisingly hawkish and tank the markets. Well, that's it for now. Thanks for watching. And if you have any comments or feedback whatsoever, please don't hesitate to email me at mailbag@investingdaily.com.